The bond market is in a huge bubble. The Federal Reserve has been buying $120 billion a month of mortgage-backed securities and bonds, which has caused interest rates to go down, the price of or the value of bonds to go up. But what's really important to know is what goes up must come down. So when inflation rises, as it is right now, eventually the Federal Reserve will have to raise interest rates, and that will cause the value of your bonds to crash. So I want to give you 3 reasons and 3 easy steps of why you should consider selling your bonds. All right, so I wanted to welcome you. If you're joining us for the first time, we do videos like this about financial topics and multifamily investing, other sorts of alternative assets, and just how to preserve your wealth. So I wanted to talk to you a little bit. My background, I was a registered investment advisor for a number of years. And one of the challenges with being an investment advisor is that you're encouraged to sell Wall Street financial products. You're encouraged to sell bonds, you're encouraged to sell stocks. Even though stocks and bonds have had multiple seasons where they've crashed by over 50% within 12 months. Gosh, that sounds really risky, doesn't it? Yes. Well, why do we feel that stocks and bonds are safe investments? Well, it's because Wall Street firms spend billions of dollars to educate people like you and me that stocks and bonds are safe and that they're normal and everybody does them, and why wouldn't you do them? But the challenge with paper assets and just a lot of different assets in general is that when someone is selling something, you can't always trust the person that's selling it to you because that they're going to be unbiased. For example, I've used this example. If you go to a used car lot and you're asking for what car would be a good car for you, you're not necessarily going to get an unbiased opinion, right? Fast Eddie is not going to really keep in mind exactly what you need. He's going to say, I've got this great minivan here for you, and you look great in a minivan, or a 1978 Oldsmobile, or whatever he's got on the lot to sell. So that's really what Wall Street is. Wall Street is really there out to try to sell you stuff, not necessarily that you don't need, but trying to sell stuff that paper assets, things that could be at inflated prices, whether it's stocks or bonds, just trying to get you in a mix of financial assets that allow them to be easily traded. So if you look deeper around Wall Street, there's just all kinds of conflicts of interest, all kinds of things going on with there. I actually did a video on it. You can check out the video up here about my come to Jesus moment as an investment advisor and how I realized I had to leave because it just, to me, felt like a real ethical conflict to stay in that world. So we're gonna talk about stocks and bonds and kind of this mix, this magical mix that they say. There's something that has to do with your age. So what they do is they have this formula over here. You can see they'll take the number 100 minus your age. So if you're 50 years old, they'll say, okay, well, you should have that amount in bonds, whatever your age is. And that's kind of how you should mix between stocks and bonds, 50-50. Now, not everybody says this, but this is a common thing people use with stocks and bonds. They're saying if you're 50 years old, you should be 50% in bonds. Now, they say also if you're 70 years old, then you should be 70% in bonds. That's very, very heavily allocated into bonds. And basically the assumption is that bonds are really safe. They have a steady payment. They give you 4, 5, 6, 7%. Bronson, what in the world is wrong with a bond? It's a steady payment. It's a steady stream. Well, it's important not just look at the stream of payment. It's important to look at the value. And the value of bonds is really, really in jeopardy right now because you can hold that to maturity, but let's say you have a 5, 6, 7% bond, but inflation picks up higher. And inflation right now, there's a lot of speculation. We're going to get into that. It could be between 5 and 14% right now, at least at the time of this video. So if you have a fixed rate anything, there are some real challenges with being in that. There's a gentleman named Chris Cole, Artemis Capital, who wrote a paper called, it's called The Allegory of the Hawk and the Serpent. And you can find it, if you search it online, you can find it. And he basically says, if you use this stock bond mix here with your age, whatever, he said between 1929 and 1970, around that, I might get the date slightly wrong, but you would have gone broke 3 times. And that's really because of the risk that is built into bonds, especially, and with stocks. You're going to see crashes on both of those. So it's really important that you look, whatever you're investing in, you want to understand how you could lose money. What are the ways this could possibly go wrong, and how likely is it? And right now, I see, and many people see, bonds sitting on this sea of thin ice that's just about to crash. and it's going to go down. So stick around. You're going to like it. If you've been enjoying this video, please smash the like button. It'll help other people to find this video. All right, so this is step number 2, the problem with bonds. Now, bonds themselves there's not a problem with bonds, but it's how bonds work when it comes to interest rates. So when you look at interest rates and how they affect bonds, when interest rates go down, you can see on this little thing here, interest rates go down, then the value of bonds go up. So it's an inverse relationship, and it's really important to see. So when you look at this chart over the last 41 years, from 1980 up here, we had 15% for the 10-year Treasury, and now we're at 1.2%. So if you bought bonds anywhere along this way, the bonds that you held over time, they were typically worth more because interest rates were going down. So as long as interest rates are going down, the bonds that you currently hold are worth more. Now, if that goes the other way, you've got a problem. Houston, we do have a problem.
Houston, we have a problem.
And so looking back over here, there's really a significant interest rate risk. And so what I mean by that is Warren Buffett has a saying, and he says, be fearful when others are greedy, and be greedy when others are fearful. Now, I'm not saying he's saying you should be afraid or you should be, greedy. Those are things you should do. But when things are really hot, it's really important as an investor that you pay attention and you have some caution. And so right now, when everything's really hot with bonds, you could say, oh my gosh, Bronson, this is great. Bonds are on fire. This is awesome. Well, the challenge then is really to be concerned about what happens when that equation flips, because it's not a matter of if, it's really a matter of when. And what could cause that? What could cause interest rates to rise? We're gonna touch base on that. So right now, 10-year Treasury is at 1.2%. The lowest we've ever seen is 0.55%, which was last year. The average historically is around 4.2%, going back some years, and then we've seen as high as 15%. 10-year Treasury on an annualized basis. So the thing that really can change all of this, because you can say, well, why wouldn't the Federal Reserve just leave it the way it is, right? If it isn't broken, don't fix it. I agree, except there's this pesky little thing called inflation. It's like you're driving along, you're riding on your bicycle, and all of a sudden something goes between the spokes and it just causes you to completely wipe out on your bicycle. That's kind of what inflation is and what it looks like. So the question really comes now is, what is inflation? I've talked a lot in these videos about inflation. The Federal Reserve says it's only 2.4% per year. Even it's 5.4% right now, but it's transitional, transitory. It will go away, which, there may be some truth to that. But there are sites like Shadow Stats that show if you use prior metrics with the CPI, which I did a video about the CPI lie, but anyway, just the idea that it's actually between 5% and maybe as high as 14% if you look at shadowstats.com. So you can take a look at that and see. But really, when this changes, they have to start raising interest rates. And the reason why is because if inflation is high, interest rates are low, it continues to really stoke these inflationary fires. Asset prices cost more, everything costs more, and the people that really suffer are savers. There's people that don't own assets, or if you hold bonds. So we're talking on this video about bonds or annuities, anything with a fixed rate or that's just in cash. So again, if I'm paycheck to paycheck or I have no savings, I'm just going to be concerned every month, every few months, everything costs more. Food costs more. All these things cost more. And so eventually they'll have to raise interest rates to try to cool inflation. So that's kind of, there's a way that happened. And when we look back to 1980, that's what happened. This big chart over here that Paul Volcker was able to raise interest rates to a ridiculous level, close to 20%, and was able to kind of calm inflation. So really it's important that we look at kind of alternatives to this, being in a situation where you have a fixed rate return and yet inflation picks up and you're still getting paid at a fixed rate. I'm not just talking about hyperinflation. I'm not just talking if things go absolutely crazy, which is a possibility. I don't know that it will happen. It could happen, but just really that you are in assets that will protect you from that, where there's some inflation protection. So if you're in bonds that are paying 4% and all of a sudden the same bond, the new bonds come out and they're offering 8%, then those bonds that you hold at 4% or 5%, whatever they are, they're going to be worth a lot less because these new bonds are available. So this is just something to be really aware of and be really concerned about, because you always want to watch out for your downside. There's always things that can go wrong in any investment, and it's just really important that you understand if something goes wrong, what that is. The worst thing is for you to be blindsided and not be aware of the interest rate risk if interest rates rise. And so that's why right now I don't really like bonds much at all. So we're going to talk a little bit about inflation protected assets and things you can do in this season that, if you sell your bonds or if you get out of bonds, what you can do with that. So we'll come back with step number 3. All right, so this is step number 3, inflation protected assets, and why those are so important, particularly when we're talking about bonds and other fixed sort of income type of things. So most people that are interested in bonds are very interested in having fixed income, knowing that the amount of money I have coming in is going to cover my expenses, right? Well, the challenge with that is if inflation picks up, you have a fixed payment coming in, even if you're not looking at the value of bonds, if you're looking at the payment you're getting from bonds, but the cost of everything you need is going up. Maybe your house payment hasn't, but food, travel, clothing, and health insurance, all these things are going up. So people typically that are interested in fixed rate, it's typically retirees, people that really want that security to know that income is going to come in. But right now, bonds don't offer that security. So be very cautious, be very aware. When you're looking for yield and cash flow, I just don't think bonds or annuities, anything with a fixed rate, is a good choice right now for quite a number of reasons, including with inflation. There's something also very interesting called TIPS, which is treasuries that are inflation protected. So they're basically tied in with the CPI, saying that, we're going to give, if inflation rises, we're going to give you a higher return. But I did a video about this, about the CPI. I called this section the CPI lie. And you can check out that video up here. I had a lot of fun making it. But basically, the government is incentivized to make you think inflation is lower than it really is. So again, we talked about it could be 5%, it could be 10, it could be 14. We don't know exactly what it is, but TIPS are never going to pay you exactly what that number is. They're going to basically have much incentive to try to have the CPI be much lower than inflation really is by moving things out and changing some of the metrics there. So when it comes to it, this is a strategy that you can use to basically use some of these low rates to your advantage when you actually invest. So again, I'm not giving you specific advice, but this is something that people are doing, and I think it's really creative and it's good, is finding long-term debt, whether that's in a mortgage, home equity line of credit, things like that, not adjustable, but fixed long-term debt, and then investing for a shorter horizon. An example of this would be a 30-year fixed mortgage, and then finding something with a 5-year horizon as far as investing and getting certain returns on that. So that's one thing you can do. So the question I always get, people ask me is, well, what do I invest in? And what do I actually do? How do I get these great returns? I mean, I'm doing fine with bonds, but what else is there? If the stock market is risky, what do we do? So there's this great thing called syndication I discovered a number of years ago. And what it is basically is passive investors can go into larger commercial multifamily deals and can invest with really experienced operators and get a lot of upside and tax benefits and all kinds of things. There's just many different types of syndicated investments. Some of them are in real estate, some are in other sorts of assets, but I love talking about this stuff. But our business really is multifamily. You can see the beautiful large apartment building house. I could have been an artist, but you can see how lovely it looks. And I did this video up here. Check this out. This is how you can 17x your retirement returns. So take a look at that, or 17x your returns on your investment. Just talking about different rates of return and things that are out there available today in multifamily or other sorts of real estate syndicated investments. It's also mobile home parks and self-storage. These offer great inflation. All of these offer great inflation protection. They also do very well in times of recession. People need places to live. If they lose their job, they might go to mobile home parks. They may be in having self-storage. They have to put stuff in self-storage. These are things you think about whether things go well or they don't go well. So it's important that you think about those things as well. Now you may be thinking, well, I'll just stick it in stocks because stocks are doing great. I'll keep sticking it in stocks. Wrong. Stocks, I see, are also very risky right now because there's so much money going in to inflate assets, and if and when the Fed does their correction where they actually start raising interest rates, this may have a serious correction in the area of stocks. Also, my friend George Gammon, you can check out his video up here. He did this video about what happens to stocks during times of high inflation or hyperinflation. He looks at both of those, and he's a brilliant guy. So check out that video above. And then I want to hear from you. Like, what are you doing currently? Like, maybe you're not in bonds, or maybe you're in bonds, but what is it that you are finding that you're going to put your money, or you're putting your money in, that both offers great returns and inflation protection? And those are two really good questions to ask, is what offers those two things? So I want to see that in the comment. That would really help. Just put a comment down there. And if you made it this far, please subscribe to this channel. We can get you the newest content as soon as it's available. Consider sharing it with friends and family. But we'll look forward to seeing you on the next video.